Hello traders, welcome back to Smart Index Edge. I am Nalnakshi Swami. In today's video, it is all about a game the market plays every day, stop loss hunting. Have you ever placed a perfect trade only to be stopped out just before the market reversed in your direction? You are not alone. That is not a coincidence, it is a trap. Today, I am going to break it down for you how smart money identifies retail stop losses, how liquidity pools are created and attacked, and most importantly, how you can protect yourself from being hunted. So, stay with me till the end because once you understand this concept, your entries, exits, and entire market view will never be the same again. Let us decode the truth behind the stop loss hunting and turn the trap into an edge. Usually, stop loss hunting takes near the some zones like demand zones, supply zones. These are the zones where most of the stop loss hunting takes place. Understanding how smart money traps traders near demand zones using price action tricks. First one is that is Wick trap, tail hit. Price dips into the below the demand zone. It dips below the demand zone, not into the demand zone, creates a long wick, hits stop losses, then reverses sharply upward. All the stop losses will be trapped. It's dip down and reverses here. Zoom. Usually at the demand zone only, many of us will get trapped. We think it is a buying zone when we will enter. We don't wait for it, actually, wait for the action to complete. This is the on and on game in the market. How many times, I don't know how many times you might have got stop loss hit. Here in the Nifty example, on 21st, you can see on 21st, this is Friday's, this one. Market has come down and you can see a little bit of reversal, like a demand zone has been created before closing. The next day, what happened? You can see a long tail wick coming below this zone and hitting all the stop losses. Because the people around 11:30 or something, it started reversing. I'm on the hourly chart. So when hourly chart is reversing like that, the demand zone has been created and the people who have taken position for BTST trade and their stop losses are here. This is the money pool. Intentionally, a demand zone was created and a money pool was created here, and then it was with the long wick, all the liquidity has been swept, and see the candle how it is closing. This is what happens in the market. Another one is zone fake break, false breakdown. That means one is wicking out, another is prices closes below demand, looks like a breakdown, but quickly recovers and reverses up. That type of trap is also there. What we will think is it is a breakdown of the demand zone, and continuation of the bearish movement, then what the market will do, it will reverse. This is an example. See, the prices come into the demand zone, dropping down, and the people start pressing the button, closing below the demand zone. And you can see the reversal over here. Another third type is multiple tests with sudden flush. After 2-3 tests of a demand zone, price drops sharply to trigger stops, then reverses direction. That type also you might have observed in the market. Here, so many times, see, it is hitting the demand zone so many times, it hits and reverses, hits and reverses. And you will not be convinced by that move, but suddenly it reverses. Fourth type is inside candle trap. An inside bar or dozy forms near the demand zone. Even on the daily time frame or on the intraday time frame, you will see this. The next candle fakes a breakdown but closes bullish. Inside bar, maybe a bearish inside bar, it goes down and reverses. That type of trap will be there. Here is an example of Nifty inside bar. This is a bearish down move, and an inside bar. You can see the next day it is faking down below all these levels. It will be on live market, it will be a very red candle. If you are watching on the intraday time frame, you will think it is a down move and it reverses. Stop loss hunting. It hunts all the stop losses below this because it reverses. This is a pin bar, inside bar, and goes below this and reverses. That type of reversal, but the continuation, you can see the next day market continues. You can see how the market comes down. Even here also you can see the trap. It is a bullish candle over here, closing at the top, next day gap up and coming down strongly and taking the stop loss, and finally reversal will come. This type of price action you will see, but if you are careful, if you read the chart, if you make or if you journal the chart reading into a playbook, definitely it will stay in your memory. These type of fake outs and traps will happen on and on to trap the traders' money. Here in this Bajaj Finance, again I am explaining the inside bars. See, market had come down, an inside bar. Next day is also inside to inside bar. This type of reversal pattern is also repeated in the intraday time frame reversals, and this is a daily time frame. You can see the candle, it is going down, trapping all these inside bars, stop losses, and a strong reversal you have seen. So once you see the candle, that is an indication that market big money is in. You can make out big money is in. Even here you can see the market moved higher, trapping all this, the stop losses above this seller stop loss and closing at the bottom. This is how the trap happens even in the wicks also. So you need to be careful. And this is a classic setup of intraday reversal as well as in the daily time frame. Gap down into the demand zone. What happens? Sometimes price opens with a gap down into demand, triggers panic, huge demand. That usually happens in the early in the morning. Opening bell itself for an intraday trader. If it is a strong reversal, it is a boon for an intraday trader to trade. Strong panic, but reverses strongly upward. The BTST traders will be crushed. Here you can see in Nifty 1 hour time frame. I have marked this. The market had closed here previous day, and the next day it gaps down into the demand zone. You can see on the left side there is a demand zone, gapping into the demand zone and strong reversal. Strong bullish candle, and you can see the market reversing very strongly, and then the continuation of the uptrend. You can see over here in this example. You might have experienced that many times. Gapping down into the demand zone and strong reversal. Not all the time. But sometimes it will be, if it happens, that will be a strong indication that market is going to strongly reverse. You can see over here, the market moved higher, came down, created a demand zone and made an higher high and then dipping into the demand zone. You can see all these people, big money. Actually, for the big money, it is a liquidity problem, not like us, because their orders will be in crores, millions. They don't have liquidity. There should be some seller if they want to buy in that huge quantity. For that, they need to create all this drama. They will be waiting with their nets for the stop loss order zones to sweep that liquidity and turn their shares into buy orders. That is how it is, whether it buy orders or sell orders. Demand zone fake continuation. Another one is price touches demand, bounces slightly, dips again to fake breakdown, then reverses strongly. Even this type of play is also done. Price touching the demand down, it doesn't go into the demand zone, bounces slightly and dips again to fake breakdown, then reverses strongly. It touches into the demand zone, breaks down, and reverses strongly. So, if only the traders will, if they are not careful, if they don't see the market, this type of movement happens in the market, the traders, we will be left with cry. You can see the person, if you are a professional who has got observation capacity, day-to-day plays, then he will be happy. Here, in this example, voltas, you can see price is coming down, a green candle is made, reverses and dipping into the demand zone, price touches the demand zone and reverse. You can see closing inside this green candle. See, it has gone into the demand zone, bouncing. Next candle, you can see reversing again, dipping again. Even on the intraday time frame, you might have seen this presentation. A long wick candle will be presented and a reversal. People think that it is a strong reversal because retailers have been taught for the reversal wick, reversal wick candle. Immediately they will jump into the trade. But to this, they keep their stop loss and market reverses. Next candle reverses. And even on the intraday time frame, it will be presented. I am showing this chart on the intraday time frame only. How the strong reversal came. Next candle, you can see the big bull candle engulfing all this price action and price continuation. After retesting, again price comes back. The next day, price has come back to this level and price moved higher. This is how it is. You should know. Another example is demand zones and supply zones are created near the previous day's high and previous day's low. People do not give importance to the previous day high and previous day low because these are the supply and demand zones. Here in this example, price is opening within the within the area of the previous day, within the boundary of the previous day, gapping down. You can see the first candle gapping down, opening and traveling high. So this will be a big green candle. People think that it is a reversal. Live market, it will be a big green candle. People think that reversal enter into the buy trade. So it is a caution. You need to, when the price opens within the area of previous day, boundary of the previous day, you need to wait for the price action. You can see the price action over here. After trapping this, people might have got trapped. And then and then market reverses and people go short. And it reverses back into the same area to hunt the stop losses here. Because people might have gone, they don't keep their stop loss properly. If they are selling here, they have to keep their stop loss at the top. Not here, not at the wick. See the manipulation. It has gone up there. And the people here, another trap. You can see within the same area, trapping the intraday time frame, intraday level, thinking it is as a demand zone. It is a demand zone. From where the market had reversed strongly, it is wicking below that and reverses. Within this area, you can see how many traps in that. This type of trap will also happen. So intentions cannot be made out immediately in live market. But if you give importance to the zones where you are trading, where it is opening, where the market is opening, then you will be very cautious. What the price action? So you need to journal all these things. This type of trap is also there in the market. That is a caution when the market opens within the area boundary of the previous day. Whether it is a gap down or gap up, you need to be careful. Here in this example, same thing. The previous day's boundary, market is gapping up and then retesting, traders start selling because they immediately, they don't mark this previous day high and low, and when the price has opened within the boundary and price has started coming down, traders started selling over here without giving anything, and you can see the strong reversal and making a double top, coming up to this the previous day's high and then reversing, and it has not done, even it has not closed near the low, closing here. Next day the down move has continued, trapping all these things. This type of price action is also presented in the market. These traps are presented. So traders don't near these demand zones, only this play will happen. So you need to be very cautious. See, if you wait patiently and if you see the price action with cool mind, you can guess. And if before taking the trade, you need to observe all these things. What is happening? Randomly, you pick up stocks from the screener and try to trade on the market on intraday. So that's why traders are not successful in intraday, on intraday. Here, in this example, just a day before, this is on Wednesday, what happened? You can see. The Nifty presented a down move and closed near the bottom on Tuesday. This is Wednesday move. Again, priced opened within the gap up, gapped up, and started selling. Same presentation like the before one, Voltas. What did it do? It started rallying and going past above this level. Open high candle. Stop loss hunting. It rallied hard and traveled up to the level where the strong, here you can see open high candle coming down, reversal candle. This is Thursday. That is 17th, Thursday, market moved down and it is Friday. This is the Friday's price action. Monday, going below the demand zone and reversing. Trap, again trap. And here, the people might have started selling, they have gone short and they might have trapped over here. It is double double top it made, and open high candle gone above the open high candle and grabbed all the stop losses over here, liquidity hunt, because this is the supply zone, strong supply zone. The market moved higher, presented as if it has stopped below the supply zone, closed near the top, and next day, yesterday, market on Thursday, gapped up and opened here and started doing. And it was a down move. Again, it has trapped all this buyer's money, whoever gone long, and fill this dynamic liquidity and gap down. It has gone below this demand zone. You can see wicking below the demand zone. This is the wick demand zone from where market moved higher and wicked below this and created a zone over here. Probably, and I'm not going to discuss about the price action of today or anything, just it is a presentation how the demand and supply zones are played as a trap zones for retailers. Retailers, if they do not give importance or if they do not uh, monitor all these things, then they will end up in trapping. Here in this example, State Bank of India, same thing. Here, the market closed, started its down move, again trapping above this structure, intraday structure, no, previous day's high, and coming down, closing here. See, the next day, market opened within the area, within this area, a dozy candle dipping below this and closing inside. It is not sufficient for this because lot of orders were there. And again a strong red candle has been presented in the market, and this is a trap. The people think that it is a strong breakdown from the, because this is the trend down, breakdown, they will press button and they don't see whether there is any demand zone on the historical demand zone. They don't see that. Actually, it flushed into flushing below the previous day low, presenting a strong reversal, red candles with the tails. You can see the tails, white these tails. And the market reversed, hunting these stop losses, hunting sellers' stop losses, and going strongly, almost rallying up to the previous day selling zone. See the area here. And again, see the liquidity ping pong, how the market is coming down and grabbing this liquidity, grabbing below this level, previous day low, again wicking down, and then a strong reversal is seen. Reversal bar is seen, just a big reversal bar. And people do enter into this big reversal bar, they don't wait for it. Never do that. A strong big bull bar, you should not enter. Wait for the discount. Then only you need to enter and the price action will be clear. This is how the traps happens near the demand zones. So you should consider previous day high, previous day low, weekly high, and monthly low, monthly high. If you know all those things, if it is on your chart, then the trap zones will be identified clearly. In this example of ICICI Bank, same thing. You can see a different type of trap. See the previous day high and previous day low. A big bull candle moving above the previous day high. It's a big bull candle. Immediately, breakout traders jumping into the trade and closing below this. See the close. See the open. See the high. How so big, huge it is. Who can do this? Institutional candle. It is an institutional candle. And halting near the zone. People think, again the big bull bar, big bear bar. You should not press the sell button when you see this bar. You should be doubtful always. You can see the next consecutive bars, very small bars, and the market rallied, again trapping. See, stop loss hunting. This is a breakout trader jumping into the trade, and this trader who thinks by seeing the red candle, breakdown trader going short, their stop loss has been hunted and the market has rallied strongly on the same day, going and closing very strongly at the top. This is how it is. Next day, it has formed an inside bar, and you can see ICICI Bank forming an inside bar at the top. So you need to mark the break. So area of demand is here, and you should never go short in this. People do mistake taking a short trade in this area. Don't do that because it is a strong rally is there. A big money is there present over here. It has played the game. They will not let you. You will not be successful. So this type of traps will be there. So previous day high and previous day low or the immediate supply and demand zones, you need to be careful. So how you can protect yourself by stop loss hunting is if you have the armor of patience, you have to wear the armor of patience. Then only you can be avoided by stop loss hunting or hit by stop loss hunting, you can get saved. So, what is the rule? Patience. You have to adopt patience. Don't have FOMO, fear of missing out. Wait patiently. Trade will come to you, especially near the demand zones, supply zones. The traps will be played. It is a caucus. You need to be careful. So, to be with me, to have more insights into these traps and trading insights, be with me. Subscribe to my channel. Smart Index Edge will become your shield for your trade. Thank you very much, friends. Nalnakshi Swami, signing off.